Did you know that investing just $100 today could grow to thousands by the time you retire? It might sound too good to be true, but with the right strategy, it's entirely possible. Welcome to this video, where we'll explore exactly how you can turn a small investment, like $100, into a retirement fortune, just by leveraging the power of the S&P 500. Whether you're brand new to investing or looking to strengthen your financial future, this strategy is simple and practical for anyone to follow. We'll break down the basics, from understanding what the S&P 500 is, to how compound interest can take even the smallest contributions and turn them into a life-changing sum. And don't worry, this isn't about risky moves or complex investments. It's a beginner-friendly, tried-and-true approach that has helped millions of people build lasting wealth. So if you're ready to learn how to make your money work for you, even if you're starting with just $100, keep watching. The S&P 500 is one of the most popular and widely trusted benchmarks for the U.S. stock market. Simply put, it's an index or a collection of the 500 largest publicly traded companies in the United States. These are big names you've probably heard of, like Apple, Amazon, and Microsoft. When people talk about investing in the S&P 500, they're referring to putting their money into a fund that mirrors this index, giving them a small piece of each of these companies. One of the reasons the S&P 500 is considered such a reliable choice is its historical performance. Over the past several decades, it has delivered an average annual return of about 8 to 10%. This means that, on average, people who invest in the S&P 500 see their money grow by this rate every year, though there are ups and downs along the way. If you're looking for an investment that has consistently grown in value over time, the S&P 500 is often the first choice for both beginners and seasoned investors. Now let's talk about the magic behind turning $100 into a fortune: compound interest. Compound interest is when you earn interest not only on your initial investment, but also on any gains that investment makes over time. Think of it as interest on interest. So, if you invest $100 today, you'll earn returns on that initial $100, but also on any growth from that investment over the years. Over time, this effect grows exponentially. Here's an example. If you invest $100 in the S&P 500 with an 8% return each year, you'd have $108 after the first year. But in the second year, you're not just earning 8% on your original $100. You're earning it on $108. This cycle repeats, and over decades, it can turn even small, regular investments into substantial wealth. This is the true power of compound interest. The earlier and more consistently you invest, the more you benefit. Starting with even a small amount, like $100, can set the stage for significant financial growth in the future. To get started with investing, you'll need a brokerage account. The good news is that many brokerages now offer low-cost or even no-cost accounts that are quick and easy to set up. You can choose from platforms like Vanguard, Fidelity, or Robinhood, all of which allow you to start with small amounts and typically have user-friendly mobile apps. Opening an account usually takes just a few minutes and can be done entirely online. Once you've set up your account, you'll want to look into low-fee index funds, or ETFs, exchange-traded funds, that track the S&P 500. These funds allow you to invest in the entire index with just one purchase, making them an affordable and diversified entry point for beginners. Vanguard's VOO or SPDR SPY are popular choices with minimal fees, helping you keep more of your returns over time. Another option to consider is investing through a Roth IRA, which offers fantastic tax advantages. With a Roth IRA, the money you invest grows tax-free, and you won't have to pay taxes on it when you withdraw at retirement. This can make a huge difference in your long-term wealth accumulation and is a smart move for anyone serious about building a retirement fund. Now that you're set up, let's talk about how to keep building on that initial investment. One powerful strategy is called dollar cost averaging. This means you invest a fixed amount, say $100, at regular intervals such as monthly. By investing consistently over time, you reduce the risk of buying when prices are high and benefit from a lower average cost per share, which can smooth out the ups and downs of the market. Of course, starting with $100 is great, but as you're able, consider gradually increasing your contributions. Even adding a little more each month can make a big difference over time. Think of it as paying yourself first. The more you invest, the faster your wealth can grow. Increasing your contributions as your income allows not only speeds up your growth, but also sets up a powerful habit of saving and investing for your future. One of the most important aspects of investing is understanding the value of time and patience. While it's tempting to want quick gains, the real magic of investing comes from holding on to your investments for the long term. The biggest returns often come after 20, 30, or even 40 years. The longer your money stays invested, the more it benefits from compound growth, allowing it to multiply many times over. Imagine investing $100 every month in the S&P 500 over 30 years, with an average annual return of 8%. After those 30 years, your account could grow to over $150,000. Now imagine doing this for 40 years. The growth would be even more impressive. Staying the course, even when markets dip, is the key. By being patient and sticking to your plan, you give your investments the best chance to reach their full potential, making a big difference for your retirement. As exciting as it is to think about turning $100 into a fortune, it's important to remember that investing always involves risk. The stock market, including the S&P 500, experiences ups and downs, sometimes dramatic ones. Market volatility, or the frequent price fluctuations we see, is a normal part of investing. There will be periods when your investments might temporarily lose value, and this can feel unsettling, especially for new investors. The key to handling this volatility is to stay the course. Remember, the S&P 500 has historically rebounded from downturns, even during major economic crises. Sticking to your plan and avoiding the urge to sell during dips can make all the difference in reaching your retirement goals. Over time, the market has shown resilience, so it's essential to focus on the long term and not let short-term fluctuations derail your strategy. Patience and consistency are your greatest allies in building wealth. Let's quickly recap what we've covered. By starting with just $100, consistently investing through an S&P 500 index fund, and letting compound interest work its magic over time, you're setting yourself up for substantial financial growth. This approach doesn't require a fortune to start. It's all about steady contributions and a long-term mindset. Now it's time to take that first step. Open an account with a brokerage that fits your needs. Make that initial $100 investment and commit to growing it over time. Every small step you take today will bring you closer to a comfortable retirement tomorrow. Imagine the peace of mind of knowing you're building a future that could change your life. Thank you for watching. If you found this video helpful, please give it a thumbs up and subscribe for more financial tips like these. And let us know in the comments, what's your first investment going to be? We'd love to hear from you.